Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show. My name is Jeff Bernier. I am your guide and host as we get together periodically to share ideas on how to get your life and what's helpful to you and your meaning and purpose in alignment with your resources. Get your resources in alignment with your goals and what matters. And that's what we do. We get together and talk about purpose and meaning and what gives you joy. And we marry that with topics on wealth management and general financial planning topics. And I'm recording this today here late in January, so I wish you a belated Happy New Year. And I know a lot of you probably have New Year's resolutions or you set goals, and I'm a goal setter. I'm no different. I set things that I hope to make this year a great year. And one of the things I've been thinking about recently, there are certain habits or activities or goals that if we accomplish them, a lot of these other goals will just take care of themselves. I had a consultant once that called these drivers. So just kind of thinking about, are there particular drivers? Are there big things that if you get those things done, a lot of other things will take care of themselves? And as I am passionate about the work that I do, it does require energy and good health. And so one of my drivers this year is just at least try to do 20 minutes of physical activity every day. And I know that sounds like a pretty low bar, but the goal is every day. And what I'm finding, it's giving me an opportunity really to catch up on a lot of great material that can help us serve you and our clients better. So I've been listening to a lot of podcasts, and obviously as I'm sitting on the bike, I'm doing a lot of reading too, on the stationary bike, that is. And so what I wanted to do this year is I wanted to sprinkle in another version of the Money and Meaning Show. I'll just call these the Money and Meaning Perspectives broadcast. So that's what today is. This is my first experiment with Money, Meaning, Perspectives. And really the goal here is to share periodically just a couple of ideas that I've read about or listened to that I think you might find helpful. There's a lot of noise out there. There's a lot of information, a lot of content. And if I can help you be a bit of a filter and just pull out a couple things that might be helpful, maybe it'll save you some time. Maybe it'll be a little bit of a life hack. Just check into the show once a month, and maybe you'll get a couple things that you don't have to go out and do tons of research. So I've got 3 quick things I'm going to chat about today. Bubbles, DeepSeek, and international diversification. And so, again, I'm sorry when I say those terms, you got to know where I'm headed with this. Let me give you a few stats. So in 1920, there were approximately 253 automobile manufacturers. 253 automobile manufacturers in 1920. By 1975, there were essentially 3. There were 3, big 3 were obviously Chrysler, Ford, and General Motors. I guess AMC had a little bit of market share as well. But we went from 253 to 3. In 1999, if you'll recall, companies that had the name .com, there were hundreds of them. Over 450 companies went public in 1999 alone, most of them related to internet and technology. By October of 1999, 199 of these companies had a combined market capitalization of $450 billion. And as you well know, most of them don't exist today. And so, we casually talk about that period of time as the tech bubble. So I want to talk a little bit about bubbles today. And I hesitate to even use the term bubble because someone that I read and respect and their research we follow in the work that we do is a guy named Gene Fama. And I'm sure you've heard of Gene Fama. He was the father of the efficient market hypothesis, and he's an incredible Nobel Prize winning financial economist, one of the best in the world. And he doesn't like the term bubble because he believes that the term bubble lacks clear meaning and testability, and argues that bubbles imply irrational price increases followed by predictable declines. And he believes neither are true, that prices reflect all the information and that they can't be predicted or timed. However, a month or so ago, Howard Marks at Oak Tree Capital, who is another brilliant individual, he's a money manager, invests in credit, private and public credit instruments, and he is brilliant, written many books on investing, and just a super, super smart guy. And he writes a memo periodically to a broad audience and to his clients. And a recent memo he titled On Bubble Watch. And he's not suggesting that we're in a bubble, but he did raise some red flags on things to be careful about in the current environment. And he basically said that one of the first adages he learned back in the 70s was that being too far ahead of your time is indistinguishable from being wrong. So he knows that, if I'm talking about this, it could go years before anything gets back to more rational valuations. But he does have some concerns about the impact of the top stocks in the S&P 500, oftentimes referred to the Mag 7, that I know you're all very familiar with. And a few statistics about the Mag 7 right now. The market capitalization of these 7 stocks is about 40% of the market, or 40% of the S&P 500. So these 7 stocks, their market capitalization is about 40% of the total. So if you own the S&P 500, about 40% of your value is in these 7 stocks, essentially. This percentage is roughly double the share of these leaders just 5 years ago. So they've really gone up a lot fairly quickly. And prior to the emergence of the Magnificent Seven, the highest share of the top 7 in the last 28 years was only 22%. And that was back in 2000 at the top of the so-called tech bubble. Another important thing to note, and we'll get to this in a moment, is because of the dominance of U.S. stocks recently, the U.S. stock market now represents over 70% of the world market capitalization. And that's the highest percentage since 1970. So, a lot of these Mag 7 or top stocks in the market are trading at high multiples to earnings. And that assumes that they're going to keep growing these incredible profits that they've got. So, they've got these high prices for a reason. They've got high prices because they've got either really good prospects or they've got high profits. Many of them have really high profits. But at trading at, 30 to 40 times earnings, essentially investors are counting on those profits being persistent over a 30 or 40-year period. And that's a really difficult thing to do. So if you think, for instance, at the beginning of 2024, only 6 companies are still in the top 20 that were in the top 20 years ago. So a lot of the top stocks 20 years ago, only a few of them are left, still in the top 20. So betting on 20 or 30 or 40 years of persistence to make these valuations justifiable is a pretty big bet when historically they don't persist and stay in the top over that long period of time. It's important to note as well that Microsoft, of the Mag 7, Microsoft is the only one that was in the top 24 years ago. So again, he's not suggesting we're in a bubble, but just to be careful. And I think his main point is really that a bubble is usually not just about economics, it's about psychology. And if you remember, Alan Greenspan used the term irrational exuberance many years ago describing the market. And that's kind of the psychology when you're in a bubble. It's just, there's no price that's too high. Outright adoration of these companies and the belief that they can't miss is another characteristic. A fear of being left behind. You've heard the term FOMO, fear of missing out. And then again, the conviction that these prices are too high. So really his caution is, that, it's not what you buy, it's what you pay that counts. Good investing doesn't come from buying good things, but buying them well, meaning at reasonable valuations. His other cautions are there's no asset so good that it can't become overpriced and thus dangerous. And there are few assets so bad that they can't get cheap enough to be a bargain. And of course, again, he's not suggesting that these are in a bubble, but investors shouldn't be indifferent either to these valuations. So that's point number one, or article number one, or idea number one. Idea number two is, as you probably aware, just recently, a new AI tool called DeepSeek was released. It's a small open source player out of China called DeepSeek, and it's really disrupted the whole idea around AI and some of this AI technology, and it's had a pretty big impact on companies like OpenAI and NVIDIA, which produces microchips for these artificial intelligence engines. Peter Diamandis, who is a futurist and forecaster, and he wrote just this past week a little bit about DeepSeek. And the results of DeepSeek, I keep saying, I'm mispronouncing that, the results of DeepSeek are pretty astounding, what they were able to do. Now, I know there's questions about security and safety in China and a lot of things, but what they were able to produce, regardless, is pretty incredible. They were able to produce an engine that's pretty good as compared to ChatGPT and others at a training cost of about $5 million, where the others took about $100 million. So much cheaper to train the engine. It takes computing power. And again, I don't understand any of this, but you went from about 100,000 GPUs all the way down to 2,000 GPUs. So the energy and the microprocessing needs were significantly reduced. 95% reduction in cost to produce this, and fewer than 200 people. So, and then finally, they released it as open source, which meaning programmers can take the code and manipulate the code and customize the code and do other things with it. And as you saw earlier this week, stocks of some of these processing companies and chip companies and others related to AI had a pretty tough beginning of the week because, again, this is creative destruction. This is other companies coming into the space and innovating, which I think is related, a little bit to what I was discussing before about, 250 roughly automobile manufacturers ending up being 3. Well, the automobile was game-changing to us, just like the internet was game-changing. But it's impossible to predict who the final winners are going to be in terms of individual companies. But it is very exciting and really something that I think will be transformational in terms of productivity, potentially transformation to productivity. But there will be winners and losers. And so John Cochrane, who is another great financial economist at the Hoover Institute, wrote a piece called DeepSeek Bonanza in his Grumpy Economist blog. And he basically said, from an economic point of view, this sort of advance was entirely predictable, though a bit surprising just how quickly it came. Who gains and loses? Well, obviously, those hundreds of millions of dollars of investment in first generation of AI training are going to get undercut by these new low-cost competitors. And just like the internet and just like the automobile, the winners will not all just be the producers of AI, which looks to become more like a commodity. It'll be the users. It'll be industry. It'll be the wheat farmer in Kansas, not necessarily the technology provider. So really, really exciting development. Impossible to predict the winner and loser, but it could be transformational in how we do business and how we can be more productive, similar to the internet. But, NVIDIA stock and others suffered because of this disruption, which is the way markets work. So that was idea number 2, just to kind of give you a couple of quick resources that I read about the DeepSeek release and the challenges to some of these current players. The final one is not a new message. You've heard me talk about it before, I'm sure. And remember earlier when I said that the United States equity markets now represent 70% of the world market capitalization, and that's the highest that percentage has been since the 1970s. And so it's been an incredible run for U.S. equities as compared to international equities over the last 10 to 15 years. And so many people ask today, why should I even bother to invest internationally? And, the growth in the U.S. market is justified. I mean, we've had innovation in technology, faster growth, flexible labor markets, a lot of higher productivity, and stronger consumer spending. But just like there's creative destruction in AI tools, I mean, there is competition globally in markets. And just like the U.S. market has enjoyed an incredible run, in the 1980s, Japan experienced a similar boom. The Japanese stock market rose every year from 1993 to 1990, dramatically outperforming stocks in the rest of the world. And at one point, Japan accounted for almost half the global market capitalization, if you can believe that. So while we're at 70% today, at one time, Japan's equity market was at about 50%. So again, certainly, and so as you know, Japan has struggled in the last 20 or 30 years in terms of their capital market. So while the United States market is the best market in the world, it's not indomitable. I mean, it could get some competition. And finally, there's a valuation story. U.S. stocks are expensive relative to international. So again, if you heed Howard Marks' advice about it's not just the companies that you buy, it's the price you pay, one might argue that U.S. equities have lower expected returns because of the high prices relative to international. So in closing, the purpose of diversification is to spread your bets in such a way that you reduce the odds of the worst outcomes while still benefiting from the good outcomes, because you'll still have exposure to large growth AI tech stocks if you have a diversified portfolio. You'll still have exposure. And if you're a U.S. investor, you should still probably have home country bias. So you'll still have significant exposure to U.S. markets if you diversify internationally. So really the theme here is continue to be broadly diversified, both in terms of sectors and companies and industries, as well as geographically. So hope you found some of those ideas useful. Again, we'll just put a few of these out from time to time, and if you found it helpful, I'd love to hear from you. If you've got feedback or other topics that you'd like me to check out, please give me some information. You can reach me at moneyandmeaning@tandemgrowth.com. You can check out the podcast at all the major streaming services. Give us a rating, share it, let us know what you think. Thanks for checking it out today, and enjoy the rest of your day. Thanks so much.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.